You type a few numbers into a mortgage calculator, and it says, your payment is $2,150. You breathe again. You feel safe. Then you buy the house, and the real payment shows up. It is bigger, sometimes way bigger. So what happened? Did the calculator lie, or did one tiny mistake quietly drain your money every month? Today, I will show you the mortgage calculator mistakes that cost normal people thousands of dollars, even when they are smart, careful, and doing everything right. And stick with me, because near the end, I will show you the one assumption almost everyone makes that can flip your whole decision, even if the monthly payment looks perfect. Number 1. The down payment illusion that changes everything. Most people enter a home price and an interest rate. Then they forget the down payment is doing two jobs. It changes your loan size, and it changes extra costs that show up when your down payment is small. Example, you want a $350,000 home. If you put down $70,000, your loan is $280,000. But if you put down $35,000, your loan is $315,000. That bigger loan can add hundreds of dollars a month. Now the sneaky part, a smaller down payment can also trigger private mortgage insurance, and that is its own monthly bill. So the same house can feel affordable in a quick calculation, then feel tight once the real costs show up. A better habit is simple. Always run the calculator with at least 3 down payments, one that feels comfortable, one that is your stretch goal, and one that is your minimum. Then compare the monthly difference and the total cost. Number 2. The payment you see is not the payment you pay. A lot of mortgage calculators start with principal and interest only. That is not your full housing payment. Your real monthly cost often includes property taxes and homeowners insurance, and sometimes they're collected in something called escrow, which is basically the lender holding money to pay those bills later. Example, the calculator says $2,000 a month. You feel good, but property taxes might be $500 a month, and insurance might be $150 a month. Now you are at $2,650 a month. That is a different life. And taxes and insurance can change over time. A city can raise property taxes. Insurance can jump after storms, wildfires, or higher rebuilding costs. So even if your payment starts comfortable, it can creep upward. The fix is to treat taxes and insurance like non-optional. If your calculator has fields for them, use them. If it does not, add them yourself before you decide you can afford the home. Number 3. Private mortgage insurance is not small change. Private mortgage insurance sounds like a tiny add-on, but it can be a serious monthly drain, especially early. Many buyers are surprised because they think, I am already paying interest, why am I paying insurance too? The simple answer is the lender is protecting themselves when your down payment is small. Example, 2 buyers choose the same $300,000 home. Buyer A puts down 20% and avoids private mortgage insurance. Buyer B puts down 5%. Buyer B might pay an extra $150 to $300 a month, sometimes more, depending on credit score and loan details. Over a few years, that can add up to thousands. Mortgage calculators often forget this line item unless you add it. So here's the step that saves money. If you are below 20% down, run 2 versions, one with estimated private mortgage insurance and one with a plan to remove it later. Then ask, how long will I realistically pay this? If it's 5 years, that is not a small number. Number 4. Interest rate versus APR can trick your brain. A common calculator mistake is comparing loans using only the interest rate, but 2 loans can have the same rate and different total cost because of fees and points. Points are upfront costs you pay to get a lower rate. Sometimes that is smart. Sometimes it is a money trap. Example, lender A offers 6.5% with low fees. Lender B offers 6.25% but charges points that cost $6,000 up front. The monthly payment might look better with lender B, so you think you found a deal. But here's the question most people forget to ask. How long will you keep the mortgage? If you sell the house or refinance in 3 years, you might never earn back that $6,000. You paid extra and did not get the full benefit. So use the calculator like a detective. Take the monthly savings from the lower rate and divide the upfront points cost by that savings. That gives you a rough break-even timeline. If break-even is 7 years and you plan to move in 4, that lower rate can cost you money. Number 5. The magical low rate fantasy. Another mistake is using a hope rate instead of a real rate. People hear a friend got a 5.9% rate last year, and they plug 5.9% into the calculator today. That can make a house look affordable when it is not. Rates change, and your personal rate depends on credit score, down payment, loan type, and even the day you lock it. Here's the fix. Always run a range. Example, run the calculator at 6%, 6.5%, and 7%. Same home price, same down payment. Now look at the monthly spread. That spread is your risk zone. If you can only afford the home at the lowest number, you're not actually safe. You're just lucky, and luck is not a housing plan. Number 6. Falling in love with the monthly payment, not the total cost. Mortgage calculators are good at showing monthly payments, but beginners often forget to look at the total interest paid over time. A longer loan term lowers the payment, but it can massively increase total interest. Example, a 30-year loan might feel easy. A 15-year loan might feel scary, but the 15-year option can save a huge amount of interest because you are paying the loan down faster. Here is the mindset shift. You are not buying a monthly payment. You are buying a house and a long contract. So do this step. Run the calculator for 30 years and 15 years. Then look at total interest paid, not just the payment. Even if you choose 30 years for flexibility, seeing the difference can motivate you to make occasional extra payments that cut years off the loan. Number 7. Forgetting closing costs and cash to close. Some people only look at the monthly payments and forget the day one money. Closing costs can include lender fees, appraisal, title costs, prepaid taxes, prepaid insurance, and more. This is not a tiny number. Example, you plan for a $60,000 down payment. Then you get the final numbers and the cash to close is $72,000 because closing costs and prepaid items add up. Now you have a problem. You either drain your emergency fund or you scramble. So when you use a mortgage calculator, separate 2 ideas in your head, monthly payment and cash needed up front. A smart practice is to estimate closing costs as a few % of the purchase price, then build a buffer. If your real closing costs end up lower, great, but you will not be shocked at the finish line. Number 8. Ignoring HOA fees and the costs that are not in the mortgage. Some homes come with homeowners association fees. Some neighborhoods have them. Many condos have them, and they can be big. A mortgage calculator might not include HOA fees unless you add them. Example, the mortgage payment is $2,100. The HOA fee is $350. Now your real monthly housing cost is $2,450. And HOA fees can rise. Special assessments can happen too, like when a condo building needs a new roof. Also, many people forget the non-mortgage costs of owning. Repairs, maintenance, tools, yard care, even basic things like replacing a water heater. A simple rule that helps beginners is to keep a monthly home maintenance buffer in your budget. Even $150 to $300 a month set aside can prevent a future panic. Number 9. The amortization blind spot that makes selling harder. Early in a mortgage, a big chunk of your payment goes to interest, not principal. This surprises people. They think, I paid for 2 years, I should owe way less. But amortization is front-loaded. You pay more interest early. Example, you buy a home and pay the mortgage for 2 years. You might have paid tens of thousands of dollars, but your loan balance might only drop by a smaller amount than you expected. Why does this matter? Because if you sell early, you may not have built much equity from the payments. You are mostly relying on the home price going up. This is where calculators can mislead you if you only watch the monthly payment. You also need to look at an amortization schedule. Many calculators have a tab for it. So do this step. Check how much principal you will pay down in year 1 and year 2. If it is tiny, be extra careful about buying a home you might not keep long. Number 10. The biggest assumption that can flip your decision. Here is the assumption I promised earlier. Most people assume they will keep the mortgage for the full term, like 30 years, but many homeowners refinance, sell, or move long before that. Job change, family change, neighborhood change, life happens. And this one assumption can change which loan is best, whether points are worth it, and even whether buying now makes sense. Example: 2 buyers choose between a loan with higher upfront points and a loan with a slightly higher rate and lower upfront cost. If they keep the home for 12 years, points might pay off. If they move in 4 years, points might be a waste. The way to use a mortgage calculator like a pro is to run a real-life timeline version. Run the numbers for 3 scenarios. Scenario 1, you stay 4 years. Scenario 2, you stay 8 years. Scenario 3, you stay 12 years. Then ask one question. In each scenario, how much money did I spend in total, including upfront costs, monthly payments, and the amount of principal I paid down? That is the real comparison, not just the payment. And once you see it, you start making calmer choices. You stop chasing the lowest payment and start chasing the best fit for your real life. Number 11. Adjustable rate mortgages can look cheap until they reset. Some mortgage calculators show the intro rate on an adjustable rate mortgage and stop there. That is like pricing a car by the first month's payment only. Example: a 5-year adjustable rate mortgage might show a much lower payment than a fixed-rate loan, so you feel like you found a cheat code. But after the intro period ends, the rate can change and your payment can jump. A smarter way to use the calculator is to run 2 versions, one with the intro rate and one with a higher rate that could happen later. If that higher payment would break your budget, you need a safer plan or a different loan. Number 12. Not stress testing your budget with real-life expenses. Many people calculate the mortgage payment, but they do not test it against their full monthly life. Example: the payment fits on paper. Then you add daycare, car insurance, groceries, gas, and student loans. Suddenly, the mortgage forces you to live on leftovers. A simple stress test is to pretend your payment is $200 to $400 higher and see if you still have breathing room. If you would be forced to use credit cards for normal life, the home is not affordable yet, even if the calculator says it is. Number 13. Choosing a term without understanding the trade-off. Some calculators default to 30 years, and beginners never change it, but the term changes your entire cost story. Example: a 20-year loan might raise your payment a bit, but it can cut total interest by a huge amount compared to 30 years. A 10-year loan can save even more, but it can also make your monthly budget too tight. The key is to pick a term based on both flexibility and goals. Run 30, 20, 15, and 10-year options. Then choose the one that lets you sleep at night and still build wealth. Number 14. Forgetting that property taxes can jump after you buy. This one shocks first-time buyers. The tax number you see online might be based on an old assessed value, not what you just paid. Example: the home was assessed at $250,000 for years. You buy it for $350,000. The county reassesses later, your taxes rise, your escrow payment rises, your monthly payment rises. When you run a mortgage calculator, do not use the lowest tax number you can find. Use a conservative estimate and build a buffer so your budget does not explode after the first year. Number 15. Underestimating homeowners insurance and missing special coverage. Many calculators use a low insurance estimate, but real premiums can be higher, especially in storm, wildfire, or flood risk areas. Example: The calculator assumes $100 a month. The real quote is $220 a month because rebuilding costs are higher or the area has more risk. Also, flood coverage is often separate. If you need it, it can add a meaningful monthly cost. So instead of guessing, get a rough quote early. Even a ballpark can save you from a bad surprise. Number 16, not accounting for rate locks and timing risk. A calculator is a snapshot, but your interest rate can change before you close, especially if you are shopping for weeks. Example, you run numbers at 6.2%. You go house hunting, 3 weeks later, rates are higher. Now your payment is bigger and your budget is tighter. The smart move is to build a timing buffer. If you can only afford the home at the exact rate you saw today, you are exposed. Run the numbers slightly higher so you are protected if rates move. Number 17, misreading points and credits when comparing lenders. One lender might offer a lower rate with points, another might offer a higher rate with lender credits that reduce closing costs. Many beginners compare payments only and miss the real trade. Example, lender A has a lower payment, but you pay more upfront. Lender B has a slightly higher payment, but you keep more cash in your pocket on day one. The right comparison depends on your timeline. If you plan to move sooner, keeping cash and avoiding points can be smarter. If you plan to stay long-term, paying points can make more sense. Use the calculator to test both outcomes instead of trusting the smallest monthly payment. Number 18, forgetting about your future self and payment shock. Beginners often calculate based on today's income, but life changes. Example, you plan to have a baby. One income might drop for a while, or you might change jobs, or your car dies and you need a new payment. If your mortgage leaves no margin, one life event can turn your home into a stress machine. When you use a mortgage calculator, do not just ask, "Can I afford it today?" Ask, "Can I afford it if something goes wrong?" That mindset can save you from buying a house that feels like a trap. Number 19, thinking pre-approval equals affordability. A lender might approve you for a number that is technically allowed, but that does not mean it's comfortable. Example, you get approved for a loan that pushes your budget to the edge. The calculator says you can do it, but you cannot save, invest, or handle emergencies without stress. A smarter approach is to set your own comfort payment first, then work backward to a home price. That puts you in control instead of letting a maximum approval decide your life. Number 20, ignoring the opportunity cost of a bigger house payment. This mistake is invisible because you cannot see what you gave up. Example, you choose the higher payment home because the calculator says you can squeak by. But now you invest less, save less, and pay down other debts slower. Over years, that lost investing can cost a surprising amount. A simple way to see it is to compare two homes. Home A is $2,200 a month. Home B is $2,600 a month. That $400 difference invested monthly over time could build serious wealth. The calculator will not tell you that. You have to ask the question. If mortgage calculators have ever made you feel confident, then later made you feel surprised, now you know why. The calculator is not the enemy. The missing inputs are. So here's my question for you. Which mistake do you think most people make first? Leaving out taxes and insurance, forgetting private mortgage insurance, or assuming they will keep the loan forever?